Another day of records. Let's bring in our market panel. Barbara Doran of BD8 Capital Partners and Brooke May Evans of Evans May Wealth, I should say. Brooke, I'll kick it off with you here. The fact that we are at record highs again for the S&P, for the Nasdaq, we're really grinding higher at these levels. What does that tell us about the valuation of the market, and what should we see as the next meaningful catalyst?
You know, right now, the market's not cheap, but the market can trade for a prolonged period of time at high multiples, and it doesn't necessarily indicate that a correction is coming. But we are near our 52-week year-end price target, and so we're looking for other areas to add performance to our portfolios, and we're shifting now to small cap. We've been underweight small cap for the last 2 years, and while we don't think lower earnings will bleed through to small cap, while we don't think lower interest rates will bleed through to small cap earnings the second half of the year, in anticipation of lower rates in 2025, we think we can see a rally there. Small cap's only up 2% year to date, whereas the broad market's done significantly better. Yeah, and in a mixed day for the major averages, the Russell 2000 finishing today down 0.9%. Barb, want to get your thoughts here because we did see the dot plot. We saw the Fed adjust to just one rate cut forecast with a meeting yesterday, and yet PPI fell today. Jobless claims jumped today. What does that tell us about the soft landing narrative, and what does that mean in terms of where you should be invested in the market?
Well, I think the soft landing scenario is still intact, but I think there's starting to be and could build the jitters about, is the Fed going to stay restrictive for too long? I think the jobless claims, if we see more of those are volatile week to week. We did have the strong payroll numbers, but we're seeing other indications, whether it's the JOLTS numbers, fewer openings. It's now back to sort of one-to-one job openings for job seekers where it was pre-pandemic. So there's lots of information coming in about that jobs are softening, but we are still fine. But that could change over the next quarter or two. So I think the Fed, I think it's a little surprising that they just said one rate cut, but I think that's part of their preserving their inflation fighting credibility. And I think that we will start to hear different things if we have another good inflation print in July and then in August leading up to that September meeting. So I think, and you saw today all around the street, economists, strategists are increasing their targets in terms of number of rate cuts, now 2, sometimes 3. So I think what it means, the bull market is intact. As Brooke said, the market on the surface is expensive at 21 times earnings. But as we know, that's a handful of stocks who really, if you take that out of the S&P, it's a lot cheaper. And the question now is breadth. And I think it's probably a little too early for the breadth because it's been back and forth, this rotations into cyclicals, into this and that, because we were waiting for the rate cut. And so I think that a lot of investors will wait until we're much closer in terms of visibility on a rate cut. Okay. So I think, we're in the tech and growth stocks and
yeah, given all that, Brooke, I wonder if we're in jump scare territory for the market overall right now. The VIX is under 12. There's been this kind of risk-on bias, it seems like to me. What sorts of events might cause you to rethink your still relatively bullish position? It seems like you think the S&P could go up high single digits or at least mid-single digits by the end of the year. What would you say are the canaries in the coal mine?
Unemployment. If the Fed sees unemployment tick above 4%, they have to act. If the labor market turns, the economy can turn very quickly, and the U.S. can't afford another massive stimulus package. They have to get this right. And right now, they have the advantage of looking at Canada and Europe, and while lower rates there won't necessarily bleed through to economic data in the next couple of months, it'll be a start to be able to kind of foreshadow what we could expect here in the U.S. if they were to start to cut rates.
Okay. Adobe is out. The stock is quite a bit higher in its initial move, up about 10%. We are going through that, and we'll bring you the numbers as soon as we've got them nailed down. Barb, in the meantime, arguably it hasn't been a stock picker's market, even though a lot of people were saying after the strong moves that we'd seen in the S&P major indices over the last several quarters it would be, unless you're picking mega caps, which a lot of people wouldn't have been because the whole idea of moving away from the major indices is they had become so weighed down by the mega cap. So is it really a stock picker's market now?
Yeah, I still think it is. I mean, if you look outside the mega cap tech, the really obvious ones, you can look at some of the retail names. And you saw this in this last earnings season, the reports. It was really bifurcated. There were big winners and big losers. And of course, the ones, that we always point to, Costco and Walmart, are long-term winners. But you had a lot of names that really were hitting it out of the ballpark. And if you look even in restaurants, you have the Chipotles, the Cavas, whereas others, McDonald's not doing so well. Starbucks, has to revamp and figure out, what's going wrong there. So I do think, you can't just pick like the retail sector. You can't just, pick this sector over that. I think it's within that there are real opportunities. So I do still think it's a stock picker's market. And I think that's what we've seen so far this year in terms of where alpha has truly been generated.